Welcome to Strategy Saturday. I'm Charles Carillo, and today we're breaking down debt basics every apartment investor must know. Once you move into 5+ unit multifamily deals, you enter the world of commercial lending. And that means new rules, new terms, and very different loan structures. Let's get started. When purchasing a 1 to 4 unit property, the loan underwriting is mainly based on the buyer's income, and the loans are traditionally 30-year fixed loans. When we step into 5+ unit multifamily properties, we encounter commercial lending, which brings different lending requirements, new vocabulary, and loans that differ from residential mortgages. Let's discuss some fundamental debt concepts that every apartment investor should be knowledgeable about. Number one, different valuations and metrics. So commercial properties are valued based on net operating income, NOI, rather than comparable sales. There are a few terms regularly used in commercial lending and others that carry over from residential mortgages. LTV, loan to value. The percentage of the property's value that is financed. A $100,000 property with a $75,000 loan means the property has a 75% loan to value. DSCR, debt coverage service ratio. It is a metric that explains how much the property generates in NOI versus its mortgage payment. If you'd like to learn more about what the debt service coverage ratio is, check out episode SS134. That's SS134. Next is LTC, loan to cost, used in value add or construction projects. It's the loan amount divided by the total project cost, the purchase price, and renovation budget. Number two, recourse versus non-recourse. With recourse, if the property fails and the bank forecloses for less than the loan amount, they can come after your personal assets, your house, car, bank accounts, to make up the difference. Non-recourse, on the other hand, the lender's only collateral is the property itself. If you default, they take the keys, but they can't touch your personal wealth. Number three, amortization versus term. The term is how long the loan lasts. This could be 5, 7, or 10 years. At the end of the term, the balloon payment is due and you must refinance or sell. Amortization, the schedule used to calculate your payment, usually on a 20, 25, or 30-year basis. Number four, prepayment penalties. Unlike a residential mortgage, you often can't just pay off a commercial loan early without a fee. Prepayment penalties come in all different forms. The first one is step down. It's a simple percentage of the outstanding loan balance. And for example, this could be 5, 4, 3, 2, 1. So if you sell in year one, you pay 5%. In year two, you pay 4%, and so on. This is the most common for investors working with banks. I sold a property a few years ago, and it was a 3-2-1, meaning that after I held the property for 4 years, there was no more prepayment penalty. In the first year, if I did sell it or refinance it, it would be 3%, second year, 2%, third year, 1%. The next prepayment penalty is defeasance. So replacing the real estate collateral with a government bond. Very expensive, common with agency and CMBS loans. The next is yield maintenance, a complex calculation designed to make the lender whole on the interest they would have earned over the lifetime of the loan, common with agency and CMBS loans. Number five, different loan types. So an agency loan is for stabilized properties, usually non-recourse, has a lower rate and a longer term. Bank loans for stabilized or value-add properties, recourse debt with flexible terms and approval and structuring is heavily based on borrower's relationship with the bank. Next, bridge loans. They're short-term, 1 to 3 years, higher interest, usually interest only, for value-add properties that need renovation before they qualify for long-term debt. Next is permanent loans. So this is long-term debt for after a property has been renovated and has been stabilized. So it's typical for value-add properties to start with bridge loans and then end up being refinanced into a perm loan or permanent loan. The next part of the section is interest-only periods. So some commercial loans offer interest-only IO periods for the first few years, which drastically boost your cash flow early on by delaying principal payments. As many investors saw in the years after COVID, as interest rates increase dramatically, strong debt structuring can make an average deal perform well, and weak debt can kill a great deal. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then. Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals? Couldn't get the funding and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.